What's up, everyone? Episode 9 of Punch Card Investing. We are short one Frank today, but we got the rest of the gang here to talk about portfolio allocation and position sizing. But before we get into that, as always, be sure to smash that like button, smash the subscribe button to make sure you get future updates as well, since we put out a new one of these episodes every single week, at least we're trying to. We've been doing it for 9 weeks, so who's to say we can't do 100 more or however long this is going to keep going, because we love doing it. And to that as well, be sure to join our Discord group as well. That's always linked in the description below, where we can talk about all things value investing there as well, besides just in the chat room right here on these live streams. And then as a follow-up from last week, as a reminder, we had a giveaway that we announced where if you told us where you were listening from by commenting on last week's video, then you'd be entered into a giveaway to receive one of Karan's shameless cloner mugs, which he's holding up right now. Fabulous design with the Monish Prabhai sheep after Dolly the sheep with the Monish Prabhai mustache. So fantastic design. You get a free one of those. We will pick a winner using like a random comment picker in the middle or so of the stream. So stay tuned. But anyways, who wants to kick it off with portfolio allocation, position sizing? Because it's potentially a very overlooked thing, I think, in the value space, where we're often making very concentrated bets, and you might throw portfolio allocation to the wayside, sometimes very unintentionally, sometimes intentionally. So love to get your guys' thoughts there. Who wants to kick that one off?
I'll go if there's no volunteers.
Go for it, Tom. Jump on
it. Yeah, we can get into the nuances and kind of details of this stuff more if you like, but I basically have kind of two key things that I think about with position sizing. So the first thing is basically, if I'm wrong on a particular investment that I'm making, I still want to be in the game after that. So therefore it can't be 100% of the portfolio. There's always rule number one is don't lose money, and I think anytime you have a big drawdown, that can really hurt your long-term performance. So that's sort of the first thing I think about with position sizing. And basically, the smaller the chance I see of a permanent loss of capital, the more comfortable I am in making that sort of a bigger position in the portfolio. And the second thing I think about is, if I spend time studying an idea and come up with an investment that I think is, likely to work out quite well, I want to size it in a way to where if I am right, it makes a meaningful change in my net worth, essentially. So it's a bit of a balancing act between those two things. I don't want to size something so large that if I'm wrong, it really screws me up and it takes kind of years to recover. And I don't want to size something so small that, if you pick the next Amazon, it doesn't matter because you put $200 in it or something, right? So that's sort of the way that I think about this stuff.
Do you factor in like your future income, especially now that since we're not at Warren Buffett level to where, making a salary isn't going to make a huge dent in the portfolio. But right now, do you consider, well, maybe I can have a more lopsided portfolio right now because I know I have more income coming down very soon. Do you consider that at all in your allocation?
Yeah, it's something I think I'll hopefully consider less and less over time as the portfolio grows, and it'll become my annual income will become a smaller percentage of the portfolio, hopefully. But it is something I think about a little bit. I mean, I'm only 26 years old, and relatively early days in the compounding world. So my annual savings do sort of build the cash position back up sort of naturally. So yeah, I think you probably could get a little bit more fully invested than you would otherwise, and perhaps a little bit more concentrated. But I probably think about the income stuff more around how I size a cash position rather than how I distribute, the investments I'm making within the portfolio.
Sure.
So Tom, are you still going with Monish's structure about, the keeping it for the 2x, 3x, 4x, 5x, or not so much anymore?
Yeah, I am. So that's sort of how I think about cash. If anyone doesn't know, basically that framework is Prabhai will put about 75% of the portfolio to work if he thinks that he can get at least a double in the next 3 to 5 years, and then he sort of has these other thresholds where he'll put more of the portfolio to work if he thinks he can get triples and 4x's, and 5x's is the final threshold for the last 5% of the portfolio. So I still do think about it in that way.
What about you, Karan?
Yeah, so actually, Monish's framework was something I actually looked into earlier, but then I decided to move away from it, largely because I'm not in the same situation as him, because I'm not managing a huge pile of capital, and my monthly income did make a impact on my portfolio. So the way I was structuring my portfolio earlier was go like very concentrated, like up to 40% in one company. And I was fine with that because, every month there's some sort of cash flow coming in. So even if I'm, say, massively wrong, it's fine. Like, yeah, that is how I used to structure the portfolio, but now it's changed a bit. And I think that's largely been because I've got a public portfolio. So that's changed my perception about portfolio management, position sizing, and everything. So
How so? How's it changed it?
right,
Just more diversified to
yeah. So
limit some
earlier I was
downside?
like, yeah. So earlier I was fine with having like 2 to 3 stocks in the portfolio. Now it's I'm fine with like at least 8 to 10. Like I'm okay with having a few more companies in there. Yeah.
Still pretty concentrated, relatively speaking, to some conventional wisdom out there, which might be dozens or even hundreds or just a broad index of thousands of stocks. So, and I know one of your holdings, I think, in your public portfolio that is SPY, right? Isn't it, Karan? So you have some
Not anymore.
diverse. Oh, not anymore. That was kind of like a short term sort of cash alternative move, right?
Yeah, but I'm switching the way I kind of invest even in the public portfolio to have it more aligned to how my actual private portfolio is.
Sure.
Yeah, I think that it's just changed. Like, I'm not really looking for, like, so 1 year ago in my conversation with Brad, I'd mentioned that, before getting into an investment, I already know where I'm going to exit. So that framework has slightly again changed. And I think that's largely been inspired by the whole spawner framework that I think I'm slowly kind of warming up
Coming
to
around.
understanding. Yeah. It makes a lot of sense. Like the money's made in the waiting, it's not in the buying and the selling. It makes a lot of sense. So I'm kind of shifting my entire portfolio towards that mindset.
Karan, I wanted to ask, what's the to date? What is the biggest allocation you've put in one stock in both your private portfolio and your public portfolio in terms of percentage?
So as a cost basis, or is that after?
Cost basis, yeah.
I think we know what the answer is for after
Yeah, after.
a particular
Cost
winning
basis
stock.
was 40%. 40%.
So you've done that.
Yeah, that was the investment that like
That Jack is alluding to.
The investing that
Exactly.
starts with
Yeah,
a G.
It won't be
wasn't
named.
it like bus stop or something?
I,
Can't remember.
Bus stop.
it's
Yeah.
been a while, so like kind of fuzzy there. Yeah, so.
Yeah, it's hard to remember that one. I don't even
Yeah.
remember whatever
that
that
point
stock
was-
was that went to the moon like twice.
Thrice, but
Yeah.
yeah, no. At that point, I had just 3 companies in the portfolio. That's it. So 40, and yeah, 40, 30, 30.
Wow.
Nice. Yeah, the other thing I was. Oh, sorry, Brad. You go ahead.
Yeah, were you able to sleep okay at night, Karan, or did you find yourself tossing and turning?
Not at all. In fact, because the companies that I was in, I got them below cash value. So even if tomorrow it went bankrupt, I was fine because at least the amount of cash that they have in the bank is a lot more than what I paid. So
Go ahead, Tom.
Yeah, the other thing I was just going to mention, which I probably should have, was around the number of positions in concentration versus diversification. So I sort of think that although I follow that sort of Provide framework, it sort of comes down to the opportunity set available at the time. And it's also balancing it against just the amount of time you have in a day. Like if I owned 30 stocks or something, there's no way that I would understand all 30 of those in detail. Like if, I sort of think theoretically I'd be comfortable holding maybe up to like 8 or 10, somewhere in that range. But in practice, it's never actually got that high. And I still don't know if I could keep on top of all those companies while also having a day job and everything as well. So that's something I also keep in mind.
That's why the goal is to blow that portfolio up so you don't need the day job if you just want to do investing full time or something like that.
There you go.
Do you enjoy your day job, Tom? Would you do it if you weren't getting paid?
Oh, he can't say that now.
No, I actually really do. I would do it, but I wouldn't do it 40 hours a week.
That's a fair take.
There you go.
How about you, Jack? What do you got for portfolio allocation?
So personally, I'm in an interesting spot because I'm kind of unwinding a bit from extreme diversified into more concentrated. Since I came from the very passive school, like out of college, the efficient market hypothesis stuff, but then kind of looking more closely at the details, it doesn't make much sense to me. Some people could argue, and I don't think it makes sense to all of us. Otherwise, we wouldn't be loading up on indexes right now. So I'm kind of been unwinding that. I still have a fair amount of indexes in like my retirement accounts, partially because it's kind of hard to invest in other things. For example, with my work 401k, it's all indexes. I can't really do anything else. So I'll leave that there as sort of my safety net is how I look at it. If I'm wrong about everything, at least I'll get market returns for what I can't touch till I'm 60 anyways. So that's my approach there. But as for my actively managed stuff, I'm slowly concentrating it into a handful of stocks. I have like my monthly portfolio updates I do on M1 Finance, and most, I think over half of the portfolio is in 5 stocks, and that's continually growing larger and larger. And that's going to keep happening in the future as well, as I kind of move out of other positions and concentrate in the ones I really like.
How do you think about real estate in that mix? Because I sort of noticed that you talk about stocks almost as like an entirely separate thing to real estate, whereas if you look at an overall level, you're extremely concentrated in a couple of properties. I would have thought.
You could call it extreme, value-wise, not a ton. Because the debt's involved there, my equity in the properties doesn't look as high compared to like my equity in stocks. If you do equity to equity, I think I have actually more in stocks right now, sort of, depending on where you move the debt around. Since some of my debt isn't actually attached to property, but I kind of pretend like it is, if that makes any sense. You can kind of move it wherever in my portfolio. But anyways, you are correct that I will have an outsized amount in just a couple properties, whereas when I'm putting a bunch, let's say I put 50 grand into one property, that's $50,000 in one property, whereas $50,000 in one business might be a business that actually holds multiple properties within it. So you get some diversification within the property, like Equity Commonwealth, for example. That's a handful of properties, soon to be soon to be over 100 properties again. So you get diversification built in that way. So in that way, when I'm picking stocks, this is more of like a qualitative thing as opposed to like allocation. I definitely lean towards companies that have a lot higher cash value, have a lot less default risk, at least in my view, because I already have a bunch of debt in my real estate properties. So there's no need to take on, in my opinion, there's no need to take on a lot of extra risk with companies, since I'm already taking on a lot of extra risk by having debt on my properties. So I don't know if that answers that question, but that's kind of how I think about it.
Yeah, cool.
I have a follow-up on the 401k. So in terms of exposure, country exposure, is it mostly U.S. stuff? And then I imagine there's a lot of products within that 401k that are high fee kinds of products. So are there any low fee products?
It's all low fee. It's all low fee. It's through Schwab, so it's all low fee index funds, which is how it should be if you're going to do index funds. Yeah. Paying 1% expense ratios for a passive index fund is silly, especially given what you can get through Vanguard or Fidelity or all the big names. So it is low cost, and I actually have it over 50% in emerging and international, so outside of the U.S. Because I already have a number of U.S. stocks in the ones I've picked, and also I have an old Roth IRA, which is sort of like a 401k for those of you outside of the U.S. That has like a mostly U.S. It's a Vanguard product that allocates it more towards bonds as I get closer to retirement age. So it's like one of those. It's a robo fund too, still low cost, but That is all U.S. So I thought for my 401k, I'll take the tax deductions in the meantime, and wait until I have a more severe, not severe. I'm putting it into that. I'm focusing on that 401k because I can get a tax deduction this year, so that when I have a big write-off year, when I say buy a couple properties, get some fat deductions from doing depreciation and things like that, then I'll have no tax bill, and I could roll that into a Roth IRA, which is a product that is completely tax-free after that. So it's more of I have more of a tax lens with those things. But at the moment, my 401k is heavily weighted towards international to get some diversification there. If I'm going to have to pick some basket of indexes, that's kind of how I'm thinking.
So it sounds like that emerging market exposure is something you'd keep fairly constant rather than just being based on the current market environment with where the U.S. market is compared to where some of these emerging markets are.
It's a little bit both.
Okay.
It's a little bit of both. I do want to have some exposure outside of the U.S. right now, partly because I think the U.S., relatively speaking, it's very general, seems more expensive than a lot of emerging markets. But then again, markets across the world are very expensive right now. But when you're buying thousands of stocks, it's kind of hard to say whether the whole market is expensive or the whole market is cheap because there's so much in there. But like I was saying, I already have a good allocation towards the U.S. And if I'm going to have to go passive, I want to get the whole basket, not just the U.S. Let's try to get all over the world, with ideally not too heavily weighted towards the U.S. And ride global growth rather than just the U.S. But kind of a Ray Dalio inspiration, I suppose.
Cool.
But that eventually should be a very small portion of my portfolio. So I'll be consistently putting it there again as my safety net, but that's not what I'm really relying on for the long term.
If it's a big portion, something has gone haywire.
Exactly. And and in that case, my worst case scenario should be most people's only case scenario if they don't go more aggressive. So that's how I view that. Same goes for real estate.
Very true.
My real estate properties blow up, I still have other stuff to fall back on. And yeah, that would suck. I don't want that to happen, but you got to plan for the worst sometimes.
Yeah.
If that's a literal blow up, that's what insurance is for.
Exactly. My wife and I talk about that all the time. She's like, well, investments can fail sometimes. And because we have a lot of debt and it can be stressful at times as we kind of grow out of it, coming out of school that carried some debt in. But it's like, you have insurance if something floods, if something burns. So as long as you're properly covering yourself, you're covered from quite a few things. It's the more controllable aspects, like taking on too much debt or not having enough reserves. That's where you get burned. But when the property literally burns, you should have insurance to cover that. So, well said, Tom.
Is there some stock explosion insurance product that I'm not familiar with that I should be
buying?
Credit
default swaps.
Great.
Put options or something.
Options.
I'll let Bill Ackman deal with that for me.
Yeah. I always hesitate to call those things insurance, like any sort of derivative where you make money when something falls. But that really is how, if you use it, I'd say properly and not super recklessly like a lot of people do in certain meme stocks, it can be a good way to hedge some downside. The hard part is how do you time it? Because you're ultimately just trying to time the market in that case, or time some stock move. And that's hard enough in itself because you have the time decay. That's what really kills with both shorting and put options. With shorting, you're paying interest on the borrowed shares, so you can't really go on forever. And with put options, there's a date. They can only go for so long. So you have some much higher risk there with that sort of insurance, as opposed to like a life insurance policy where your price is fixed for however many years, depending on when you started.
And that's one of the main arguments for just holding some cash, right? If something goes wrong, you've got some firepower.
That just seems to make more sense. Go ahead, Karan.
Yeah, the loss from the options is the same as a cash tag. Like you can view it that way.
Yeah.
And it's a lot less stressful to manage cash than rolling options into the next expiration date or managing prices there. That's a whole different ballgame, the options and derivatives in general.
Well, it depends on who you are. Like if you're managing money for other people, and they want to see that you're doing something.
Yeah, show it's
Yeah,
all
I'm doing
deployed.
options.
Are you considering doing that for your public portfolio, Karan? Because I know, aren't you about 50% cash on that?
I'm at 60% cash
Yeah.
right now. Yeah.
So you could put it all into options.
I've actually put it all into SHV. So that's the short-term treasuries. Yeah.
Oh, so you get a cash equivalent in that case. Exactly. Especially now where you're making point whatever percent interest, if that.
It all helps.
Yeah, and anything's better than zero, I suppose, unless of course the governments of the world default. That would be a situation.
We got a whole new set of problems.
Speaking of blowups, who's insuring the countries?
So I can chat about position sizing. I'd say a couple years ago, I was, kind of 10% positions. That's where my head was at. More recently, I've been gravitating towards 20% positions at cost. And so I've filled 3 of those slots, within the last year and a half, I think. I want 2 more. So, but I'm not going to compromise on quality. So I've got 3 20% positions and a bit of cash that I'm looking to put to work. And then I've got the kind of magic formula test portfolio that Jack and I have talked about before. And, I don't really have my selling strategy on that figured out yet. I was kind of like, okay, I just want to get going. I'm going to start this because I know how I want to start. I don't know, if I want to wait 2 years, if I want to wait 3 years, if I want to wait a fixed time, or if, say after 2 years, I want to dig into each one to see, try to figure out, is the business getting better, or, So
is that for all of your holdings or just Magic Formula?
Magic Formula, yeah.
Sure. That'd be an interesting strategy with all holdings, I'd say. Just kind of like the Guy Spear approach. Just don't look at the stock market for
the coffee can approach in a way.
Yeah.
I'm finding more and more merit in that kind of approach. On the other hand, we get this data where, the longevity of companies, public companies, is decreasing over time. So that makes me a little nervous from a coffee can perspective. It's like, okay, how long is long enough to really get the benefits of the long-term holding without, kind of going over the cliff. So that's something I'm wrestling with.
And if you do happen to land one of those really good long-term ones, Toby Carlisle talked about it or more or less talked about it on Tom's interview from a while back. I guess it was still pretty recent.
Pretty recent.
It's those outsized returns that do great over the long term, make up for all the ones that even if they go to zero, it doesn't really matter because it's so much smaller compared to those massive gains. The question is, how do you actually land those? Since there's only so many of them.
And how do you decide when to actually cash in, right?
Yeah,
how do you not wait too long? That's something I'm still trying to figure out, but I've got time.
Yes.
Is that where the next sleep 2-step checklist comes in?
Is it 2 steps?
When you're figuring out how to sell, is the price egregious? Is the business getting better? That one.
Yeah, but then what is the line between overvalued and egregious? There's probably a fairly large gap there potentially. So,
explosion in Wall Street bets posts would be egregious.
Fair enough. Yeah, I'll consult Karan on that one.
Main beneficiary.
I hadn't even heard of Wall Street bets prior to literally when they started coming up in the news and everything.
I'd heard about them, and I have a buddy who was really followed it pretty religiously. He wasn't how do I say it? He wasn't one of them, but he would watch from the sidelines, as I think a lot of people
not a degenerate.
Yeah, exactly. But just because there's so much outrageous content on there of just people putting ludicrous amounts of money compared to their net worths, even beyond their net worth into short-term options that expire in 3 days. Like, it's just insane. And the community is it's so weird in that they like feed off the negative and the positive at the same time. And people are like shameless. They show like, hey, look, I lost 100% of my portfolio in 2 days. And like, they all get applause for it. It's nuts. Anyways,
it's entertaining at least.
Yeah. So I was like aware of it. I had no idea it had so much power, basically, to point all this money in one direction, whether they're trying to or not, whether that was intentional or not from the get-go. That's what's happening, and it's kind of nuts. I never would have thought that would happen. Small group shows this outrageous things. It's just a bunch of loons, and it expanded into so much more, which is just unreal. I don't know how else to describe it.
Do you guys know what happened in the trial with the guy who was driving the narrative behind GME? He went on trial. Do you know what happened with that? Did you follow that at all? So
that wasn't a trial. That was a congressional hearing. They want
a hearing. Okay.
The things that do nothing but are like good for media. Where they're trying to gather facts.
I thought he was in trouble. I thought there was something happening there.
Yes and no. Congress just wanted to see if they should legislate on it, and plus they needed something to put in their campaign emails. So that's what congressional hearings are for. Get some sound bites. Who did they? They didn't even have someone very important. They were missing like one of the key parties in the group for some reason. Oh yeah, they didn't even have a GameStop CEO on it or anything. they had a Roaring Kitty, the guy who was kind of the ringleader. Yeah. They had Vlad from Robinhood, someone from Citadel.
The same
I think.
Person.
Yeah, exactly. Lord Farquaad in real life and for stocks. And that was the hearing. Like, they were missing GME. They're the big, the item here, but that's just congressional hearings. It wasn't really a trial, but there were trials about going after Robinhood for shutting down trading and all that stuff. Those are still ongoing, and those probably will take a very long time to actually finish out, because there are a bunch of those lawsuits that came out suing brokerages, suing clearinghouses, suing whoever, because of the trading being shut down for quite a few brokerages. I think pretty much every brokerage shut down some sort of trading with GME when that first happened. So that's still ongoing.
So I was watching sorry, go ahead. Go on. I was watching a video about, Vlad was talking about Robinhood and the whole fiasco. And one of my buddies looked over and he's like, "Is that Vlad?" And he went to college with Vlad. He was in his fraternity.
Oh gosh!
And so he had some fun stories about Vlad that I won't share here, but it's a small world.
That's pretty.
They both went to Stanford. Yeah.
I actually came across Roaring Kitty's channel like back in August, and that time he was at like around 70, 80 subscribers or so. And I was like, maybe I should collaborate with this guy. Like, I'm into GameStop, he's into it. Like,
oh my goodness!
Maybe it'll like give him a little more, like
give him a boost.
Help
at that time.
Guy.
Sorry.
Help out this guy.
Yeah, I'm like, we can talk about the stock that we're invested in. No one seems to like, and then I don't know, it just never happened. And
hindsight's 2020.
Yep.
I wonder how that would have affected the direction of your channel, Karan. Just
that can be your new mistake of omission, Karan.
Yeah,
I guess we'll never know.
Yeah, he's got 543,000 subscribers.
Yeah.
What's the Doge guy at? Pro the Doge or whatever? Like the second coming of the same sort of thing. I wonder
not even going there.
Yeah, gosh, that's a whole other animal, but. Same genus, different species, something like that.
We'll call it that.
Even I think Seritage has been a huge beneficiary of everything that had happened. Like the stock went all the way up to like 20 something, 23, 24.
Anything with a short interest. Yeah.
Yeah.
Do they still have a substantial short interest? What are they at now? Any idea?
Well, they've fallen off that website that Karan gave us.
I think it's still meaningful, but they're not on the website anymore.
Okay.
Highshortinterest.com.
Because I think it got as high as almost 50%, right? Which definitely put it on that list.
It was like 40, 41, 42%.
40s, okay. Yeah. And that was right when all that was happening. So every stock on that list was up. That was insane. Again, shows the power of even a Reddit group.
Well,
yeah, so 21% of the float at the moment, according to Yahoo Finance, is short.
Okay. So yeah,
oh, because
substantial.
that's what GameStop is, 21%.
But then you have the operating partnership unit. So of all shares outstanding, it's 10% roughly.
Right.
Wow. That's actually that's a big decrease in a short amount of time, and not much has really changed fundamentally at the company. So it's definitely scared some short interests off.
Yeah. So we talked about portfolio stuff. Karan, did you want to talk about books at all before we jump into the comments? Maybe we want to share, what we're reading or something like that.
Good idea.
I've got the book somewhere here.
Yep.
It's called Quality of Earnings. So it's a book recommended by Bill Ackman. I just picked it up. Yeah.
Did he personally recommend that to you, Karan?
Of course, yeah. He's like, oh, you're one of our largest shareholders.
13G just came through from Karan.
It's Amsterdam listed, so.
There you go.
That'll be a movement. That'll be a moment. One of us has to file one of those.
How far are you into Quality of Earnings?
I just got it yesterday. So
Okay.
Not at all. Yeah.
Cool.
I finally started pleasure reading again, because during law school you don't really have time for it because you're reading whatever they tell you to read. So now that I'm going into the office sometimes, finally get to start getting through some of these stock books I've been waiting to do.
Pleasure reading stock books. I like it.
Yeah. I should say just freedom of choice, whether it be pleasure or not. I'm always trying to educate myself, and I consider that pleasure. So I'm like halfway through One Up on Wall Street. I actually started a while ago, and I was flipping between Principles by Ray Dalio and One Up on Wall Street by Peter Lynch. So going between those right now, and should be wrapped up with both relatively soon, as long as I keep taking the train.
Was that from the 90s? Do you know when One Up on Wall Street was?
Yeah, there's two editions, and I think the edition I have is in the 90s, but obviously the principles carry. Some of the examples are outdated, but there's lessons you could pull from it to today. I actually did a breakdown on. He had this very short passage talking about. He recommends that people buy a house in the U.S. at least, that people buy a house before they invest in stocks, and I thought that was interesting because I guess his logic was the average person puts a lot of care into picking out a house and making sure it's a decent investment. Whereas with stocks, a lot of people don't do that. They'll just hear something on the news or whatever, and we'll just throw $1,000, $2,000, however many thousands of dollars into it. Whereas with a house, people are typically, there's almost like a natural inclination to be a lot more careful. He was suggesting that people should do that first, because over the long term, that'll probably pan out as an okay investment at least. And it's something that everyone is mostly equipped to do. That was his argument, and thought it was pretty interesting coming from a legendary stock guy.
I don't know if it was Peter Lynch or someone else, but they said that your house is one of your best investments because of the duration that you hold it for.
Yeah,
like,
and it does it does depend on you actually holding it too. So it's because the average person, I think the average hold time, I think, is 7 years for a home in the US, which, I mean, is relatively short considering how expensive it can be. But still, 7 years. I bet the average hold time for a stock is like a month or something like that. But where people get into trouble is they start refinancing their home over and over. I think the average there is every 5 years. So average ownership is 7, average refi rate is 5. So if people are pulling the cash out, making that debt balloon bigger, most likely they're taking cash out to pay for whatever they can't afford. And that's where you run into trouble. That's what caused a big part of the housing bubble back in the financial crisis, and could arguably being a cause of some of this bubble that we're seeing, if you can call it a bubble, since real estate's in a dicey spot for sure.
I just looked up that stat in New Zealand, and we're at 7.4 years.
Yeah, so very similar.
Hold.
Okay.
Well, you have the different loan products though. Since I think we were talking about it off air once. What was is it a 3-year variable rate mortgage is the standard, or
Yeah, it's fairly flexible in how you can set it up. So, but the longest you can lock in your interest rate for is 5 years.
Wow.
Yeah. So compared that, then it would make sense that people might be inclined to sell based on where prices are at because you have that interest rate risk. Granted, I guess you could refi into another one constantly.
Yeah.
So it's a different game. Or in the U.S., you can
Yeah,
if you get a low interest rate, you're locked in for 30 years.
Yeah, I mean, most people are still taking 25 or 30-year mortgages here. It's just that the interest rate is only known for the first 3 to 5. Essentially.
Yeah, man, expecting the average person to do five-year payoffs, that would be intense at current prices.
Yeah.
So yeah, the payment might be the same, but the risk is very different. That's all I was kind of getting at.
Yep.
What about you, Tom and Brad? What are you guys reading?
Yeah, I actually just went and picked up a book this morning, or I sent it to my parents' house because my post is very unreliable, so I swung by there on the way here, which is Alibaba, the house that Jack Ma built, for a bit of a history lesson on Alibaba. So I've just picked that up. I just recently finished a week or so ago, Warren Buffett and the Interpretation of Financial Statements, which is actually very good if you're brand new to accounting. I knew a little bit of accounting before that, but that was a good read, and it puts everything in sort of a Warren Buffett-esque, how do we identify a moat type lens as well, which I found quite useful.
That's the most value investor title I think you could come up with.
It's a thrilling title, isn't it?
Is the content as thrilling as the title?
The content, it's funny. There's each chapter is about 2 pages long, so there's it's only like 150-page book, and since there's so many chapters, there's lots of the words finish halfway down the page, and you use up another page to get to the next chapter, so it's quite short. But basically, each chapter is a line on a financial statement, which again is a thrilling way to write a book. But it is actually really good if you want to get your head around accounting, and it gives examples of different companies right the way through. So when it talks about gross profit, for example, it talks about how does Coca-Cola and so on stack up against lower quality businesses and that kind of thing. So
that sounds so much more practical than I took a basic accounting course in college, and you're starting from you just dive straight into the vocab, no examples. It's just like, whoa. and it's such a painful way to learn it. That sounds like it would make way more sense. You'd be like, hey, look, here's a real business. And then you go from there.
Yeah, it is a little simplified, and they sort of write about moats as if you either have one or you don't, and it's very sort of black and white. So it is a bit simplified, but yeah, it's definitely practical.
But you got to start simple, with especially the accounting, because you can get into some complex wizardry, and then you're just kind of lost if you go too fast into it.
Yeah,
that's right.
Sure.
What about you, Brad?
So I got 100 to 1 in the stock market. I got it on Audible, and I think that was a mistake because, first of all, the guy's voice is very dry to me, and so much of it is just like rattling off numbers, and it's like, I can't listen to this. So I also have the physical copy, which I'm going to go through. So that's the main one I'm focused on right now. 100 to 1 in the stock market.
When I released my basic real estate book a while back, and I recorded it on Audiobook too, but it has a lot of charts in it. And I was trying to figure out how to explain the chart in the audiobook. And I kind of do, but I'm like, hey, if you're listening to this, I encourage you to go to my website, jackdeffley.com/OPR charts. And then you can see the charts.
Download the PDF.
So I could just see it. For anything that involves numbers, it can be super painful. I discovered that very quickly trying to actually create it. So,
cool. Is it giveaway time, Jack?
Yeah, I think it'd be a good time to do that. So I have a random comment picker over here.
Sorry, was that really loud?
No.
Oh, okay.
Another book that I wanted to also recommend is one that I'm reading now, is the Value Investing book by Bruce Greenwald. It's quite good. So it's really opening up a lot of new ideas for me. It's a book that's good. Someone wants to look at it.
Nice.
What's the
like a
title of it?
textbook. Just value investing.
Value
It's
investing.
Just
Yeah.
value investing.
It's like a
Yeah.
textbook, right?
Yeah, but so it focuses more on focusing on the asset values, the earning power values, and then the franchise value of the business, and how exactly does he go through that process. So,
All
good
right,
book.
guys, just ran it. We had 54 unique entries, and the winner is. Let me pull up my screen. Sorry to leave everyone hanging. The winner is Zarifi94, always following here in Israel. Hey guys, I would encourage you guys to check out the previous episode's comment log just to see the amount of places we have people listening from. It's really cool to see we have a truly worldwide audience from almost every continent. I doubt we have any from Antarctica, though. Well, maybe we do. I don't know. If you're from Antarctica by chance, if you're in a lab down there, let us know. If you're watching live, I don't know what time it is there, but
I could
definitely pipe
I
in.
could fly there for an episode. I'm probably the closest.
Yeah, probably. But otherwise, it's really cool having a truly global audience. So thanks everyone for participating. And then Zarifi, you can reach out to. Why don't you reach out to me on Instagram? I'm at Jack Duffley. Just send me a message, and then I'll let just send me a message, and then we'll get your mailing information from there. So send me a message on Instagram at Jack Duffley, and yeah, congrats on winning the Shameless Cloner mug. Now let's get into some questions.
Be sure to fill the mug up for every weekly live stream.
Yes, please do. Let's see. Going back towards the beginning of our questions here. And just so everyone knows, Frank was in the chat, and he might still be in the chat. Here's his portfolio allocation. He's got 40% towards KPG, and he does a breakdown on his channel, so go check that out if you're curious. He's pretty transparent over there, so tip of the cap to Frank there, and he's very concentrated in KPG.
And he's looking dapper. I feel like Frank should create a GIF with like some breeze blowing through his beard. That would look awesome.
Yes.
I saw one of his older videos, and it really isn't that much older. It's probably a handful of months, and it's crazy how much shorter his beard is compared to now. It's gotten very majestic.
It's compounding, man. The length of that beard.
Compounding.
Yeah, I'm not on Frank's level, but I notice if I scroll through my YouTube videos, the thumbnails, like beard gets slightly shorter and shorter every time. And then all of a sudden it goes back out because I must have just shaved, like I get sick of it every now and again.
Because you were clean all the way back in November, so it's been a journey from there too.
Yeah, true.
After Monish Movember, we'll get a clean shave from Tom.
Here's a good one from Manu. With each of your career/wealth stages, how much of your position sizing is meant for growth versus preservation? So offense versus defense. We do. I think all of us have a pretty substantial amount of cash or something like cash sitting on the sidelines, and you could call that both defensive and offensive at the same time, and that it's dry powder to go on the offense when an opportunity arises. I'm certainly mostly in focusing on growth overall in my portfolio, and I'm doing that through a variety of ways, leverage in real estate, for example, and then trying to find quality companies at good prices, like we all are. So definitely leaning towards the growth. I do have some more semi-defensive positions that are meant more as like a cash alternative. I have a lot of gold-oriented holdings, some commodity-based holdings, just more as a shorter-term, intermediate-term place to put extra cash while I wait for a larger opportunity, mainly in real estate or potentially in equities as well.
I would say for me, like you say, I've got a bit of cash on the sidelines, but I mean, the goal is growth. I would prefer to be fully invested, but it's just I can't find enough opportunities to warrant being fully invested. So the goal at a high level is to compound at a high rate for a very long period of time. So when you look at it from that aspect, it's sort of all intended to be growth. It's just in the meantime, you can't always find things to buy.
Right on.
Yeah, I'll answer a little bit differently. So when I think about growth versus preservation, obviously you can think about it like when you're young, when you're starting out, you want to kind of move the needle as quickly as possible. And then when you get, a lot of capital, you want to make sure you're not moving backwards. I want both, quite frankly, right? I want these asymmetric upside to downside opportunities where my downside is capped in a way. It's there's a floor to it, and I think that's kind of the traditional value investor approach to the game, is to focus first on the downside, make sure you're not moving backwards, and if you do really well at that, really the only option is to move forward. So that's how I think about it.
One thing I should also mention is, since I'm certainly early in my journey, Tom was talking about it a bit earlier as well. Focusing on finding ways to produce new income, like in my own job, for example, that's going to pay quite a bit more than me focusing on how to get an extra 10% in my current portfolio. And that will eventually switch to where my holdings will become much larger than my potential earnings will be, because you can only earn so much, frankly. And the goal would be to have that portfolio be at a size to where your annual salary or whatever it is, if you're running a business, and if you're running a particularly not scalable business, maybe like a service or something like that, you'd want that to become a smaller and smaller portion to where it's harder to move that needle just by adding more money to the pile. So I will add that wrinkle in there. Part of the growth focus is actually on being able to earn more in the meantime.
Yeah, that reminds me of a guy by the name of Mike Mitchell, who's at Ignore Narrative on Twitter. He was getting to the point. He was an analyst in various hedge funds over the years, and he was getting to the point where $1 million bonuses weren't moving the needle. So
Right.
he's now retired and just investing.
Investing in lumber now.
Yeah.
Yes, investing in lumber very well.
You got any thoughts on that one, Karan?
Sure, yeah. So for me, I focus more on preservation, not so much on growth. I think I'm just a little more conservative, at least in my approach. So it's like if you can just protect the downside, the growth will come.
Yeah, I think that's why most of us are attracted to value investing, because we don't want low risk, low return, or high risk, high return. We want low risk, high return, which
be unreasonable. Be unreasonable.
Yep.
Monish Pabrai mantra. Yeah,
for sure.
I don't know how much it affects you guys, but I still note 2008 is still in my head. So I've seen what a liquidity crisis is like, and how important cash is to a business and assets are to a business. I don't know. I feel like people really don't give that as much importance as it deserves.
I think you're definitely right about that. That's why when I bought my out of state rental property recently, it's like a longer distance rental. The first thing I did was set up a substantial reserve account for it. So if a roof goes out, or if it's completely vacant for a long time, or if rents decrease significantly and I can't meet expenses, I can at least weather the storm for quite some time. So absolutely, I'm not going to just put all of that into another deal and then have two deals but no reserves, because then I'm totally vulnerable to a shock. And a short-term shock is where you can make a lot of money if you have liquidity. So that definitely never want to be in that position if I can do anything about it, while of course still trying to stay invested and grow a substantial portion in the meantime.
One thing Monish Pabrai pointed out is the distance in time between bubbles tend to be how long it takes humans to forget about the last bubble.
Yeah.
So it's been some time now, 13 years.
I think he said it was 17 years, right? Between.
Yeah, I don't remember exactly.
And for similar types of bubbles as well, potentially a second run through tech now. I don't know.
You could easily say that. You could also argue that in March, had it not been for central bank action or government spending action, I don't know if we'd be sitting so pretty with at least nominal returns across the board. that was massive government action everywhere. Now, how that affects us in the long term, up for some serious debate. I'd definitely be a little bit more bearish on the long term, but in the short term, there's no question that it had a pretty substantial impact. Had they not done that, maybe we would still be talking about a substantial bear market right now.
I'd probably have more than 3 positions, I'm thinking.
Yeah, maybe. Yeah, that window to invest would potentially still be open in some cheap, good opportunities. Maybe. Who knows? The world will look very different than it does now, in at least the financial world.
Yeah, wouldn't even be close.
Nope. Looking at other questions here. After dinner investor is at it again.
He's active.
Always letting us know what he had.
That man eats well, doesn't he?
Dessert is a SPAC, and we'll see what we end up buying.
Wow.
And he's getting a dessert after that. The acquisition's still yet to be made, I suppose, for dessert.
Yeah, Jason needs to add a recommended dinners page to his after dinner investor website, I think, alongside the
add more
checklist.
tabs. Karthik asks, if you guys short a company stock, what percentage of the portfolio would be betting? Do any of you guys short or do puts or anything like that? Or would you consider it?
No, the maths doesn't work. Yeah, the best case, you'd make a double. Worst case, you go bankrupt. So why would you even play that game in my head?
Is you're at least on a short, your upside is fixed. Well, I guess on a put too, because it can only go down to 0, and then that's it.
Yeah, I mean, something like selling put options are of more interest to me, like Phil Town kind of does. But I wouldn't.
But that's bullish. That's bullish at that point. So
yeah.
You mean like selling calls? I think Karthik's going for more bearish. Like if you think something's going to go down, do you ever make a play on that?
Yeah, well, no is the answer to that.
Yeah,
I think the way people do it is terrible. I mean, the way Carson Block does it, so he actually goes after a particular company, calls it a fraud, shorts it all the way down. I think that's the way to do it. It's the ultimate test of conviction. How much do you really know about the company? And
he's actively looking for fraud. He's not really looking for like, oh, I think this company's going to fail because I don't believe in it. It's like, this is not what we think it is. Wee woo, blow the whistle. That's his approach.
Well, I'd say before you get into that kind of approach, you got to ask yourself, is this how I want to be spending my time? Is this the energy that I want to be cultivating in my life? It sounds pretty rough to me.
I do have, I almost forgot about it. Speaking of Carson Block, he wrote something about eHealth a while back, talking about how they're incinerating cash. And this was back when they were at like 120 a share. And I actually wrote a paper about it in a law and accounting course I took, talking about accounting fraud, more or less. And I opened up a put debit. So like it limited some of the costs there on eHealth, and it's like maybe $200 or so into the position, and that's like up 60% or something like that. I'm letting it just ride towards expiration. But that's like my only short put position that I've pretty much ever done, at least like with the actual intention to hold it for any amount of time, other than just messing around when I was like 19 or something. Thank you, Robert.
The kind of short research that we see from firms like, what's it, Citron, whatever.
Yeah.
Citron.
Yeah, I think that's rubbish. I mean, it's like if something's 30, it should be worth like 25. Like,
yeah, right.
They're wasting time.
Yeah, that's just like, that's not science. That's way more art than science.
I think he gave up short selling, right? Or at least publishing his short reports.
Well, yeah, because they got after what happened with GameStop, they got gutted. Yeah.
Yeah, I mean, shorting, it's one of the 10 commandments. Thou shalt not, right? And I am not a sinner in this matter.
I would never make it a substantial portion, mainly because of what Tom said to lead it off. The fixed upside. You can only double on a short, and whereas you're never getting 100-bagger on a short unless you're like leveraged out of your ears, in which case you're kind of insane anyways.
And you've got to be right on both the direction and the timing.
Right.
Very hard.
Yeah, for sure.
It's hard to do both, let alone one.
from a slightly selfish perspective, I'm still glad short sellers exist because they often have very good write-ups on companies you're potentially looking at, and they think about stuff you might not have considered, which is useful.
Yeah, I think shorts are still an important part of like the pricing mechanism of the market, even if they might be unreasonable a lot of the time. But you could say that in the opposite direction as well. You have a lot of unreasonable bullish sentiments. You get some unreasonable bearish sentiments in there, and you'll find a price somewhere in between there. Maybe it'll be more reasonable because you have shorts out there, dampening the flames a little bit. Let's go back to After Dinner Investor. If you guys found a no-brainer, huge opportunity that you were very confident in, how high are you willing to go with your allocation? This kind of goes back to original prompt, I suppose.
200%. No, I'm just kidding.
Leverage.
Yeah, no,
It's like Charlie Mungo.
Yeah, exactly. Yeah. That's an interesting question. I think it depends. Yeah, it's hard to answer a question like that without having more context around the opportunity set. Because if something's a no-brainer, that doesn't necessarily mean it's the only no-brainer in existence. Like if it's 2008, 2009, there might be no-brainers lying everywhere. So, you could buy a basket of them, and they could all be relatively small positions. I guess, if assuming, let's say it was crazy times and I'm like 100% cash, and then a no-brainer turns up, in which case that's where I'd be willing to take a larger swing potentially. It's hard to put a precise number on it, but maybe absolute max, perhaps like a third of the portfolio at cost. But
I like that.
It'd be very rare circumstances.
I like that opportunity cost analysis you had going there. What if there's a better no-brainer?
Yeah, exactly.
Is it really a no-brainer? To that leverage point, I kind of laughed at it, but then I realized if I found a great real estate deal, that's essentially what I'm doing. It's a leverage. It's a leverage buy-in.
But the leverage is very different though. Like you've got
it's not margin.
fixed. Yeah, it's you can't get a margin call. I mean, in many cases, you can fix the interest rate for some period of time.
Right. It's definitely very different, and also interest rates are low too. Low, fixed, long term. Like you got a lot working for you, at least in the U.S. with all of our subsidized mortgage programs. That's one thing.
Can you send me some of those?
Yeah. You can buy us our mortgage-backed securities if you can get to them before the Fed does. Go for it.
I've heard bad stories about those things.
I'll tell you what, Tom. Just wire me the money, and I'll take care of it.
Yeah.
Okay.
Brad and I can start a friends and family fund for buying up real estate here.
I'll send you some
fools.
I'll send you some Doge.
Doge.
Sure. Yeah, goodness gracious.
All right, what do we got next?
Would you guys sell one stock you liked for one you liked even more to stay even more concentrated? I can answer that one quickly. That's kind of what I'm doing. Not really selling, but kind of ignoring some of my other smaller positions that I kind of inherited into this value investing mindset I've started to build. So yes, I would concentrate. Maybe not by selling as much, selling some things perhaps. I would do that to answer the question in simple terms.
Did this trigger the same quote for you Pabri fans as it did for me?
What's that one?
There's one that's come to my mind now, but say it what it is and I'll tell you if it's
the mistress is hotter than the wife.
Oh no, that's not what I was thinking. But that's a great quote.
That's a good way to describe the thing that this question's kind of getting at.
Right. You always know more about what you own than something you don't own. So you got to be careful.
The question's about adding to your existing holdings, not new holdings, right?
Adding to the side chick. She's already there.
So it's about selling multiple wives to buy another one, right?
It's like going from 5 to 3.
Yeah.
Oh, that's not how I read it.
Yeah.
It's still a good point, though.
I think it's just an opportunity cost equation, really, right? Yeah, Yeah, I mean, if you have two things that you like equally and the price of one shoots up and the other shoots down, and those price movements have no link to fundamentals as far as you can tell, then I can see the argument for selling the one that's gone up and to buy more of the one that's gone down. Obviously, it's not quite that simple. Like, depending on where you are, there'll be tax consequences and so on to consider. But I mean, at a high level, I like that idea.
I think the longer you have this company in your portfolio, the more you understand it. So the fact that you're concentrating shows that you're actually getting a bit more familiar with your companies. So it's almost like a no-brainer situation. Like, the better you get, the more you get concentrated, I think. Yeah.
There we go.
Looking for another question. You guys see a good one towards the maybe the newer ones? I'm kind of in the middle.
Right.
There's a couple of mentions of the Kelly criterion, which I wouldn't mind talking about.
Can you give me a name so I can pull it up?
Frank actually mentioned it somewhere through there, and also Karthik has a Kelly criterion from Probrized Dundo Investor. Was quite complicated for me.
Yeah, there's an easy answer to that one.
There you go. Here you go, Brad.
Yeah, pretend that never showed up in the Dondo Investor. Probrized made a mistake of putting the Kelly criterion in the book.
Yeah, and that's Probrized's opinion, not Brad's, by the way.
That's right.
Yeah, I like the idea. So the Kelly criterion is basically, for anyone that doesn't know, is like a formula where you put in the odds of a particular bet, and it tells you how much of your portfolio to bet on that situation. So I like the philosophy of Kelly. When the odds are heavily stacked in your favor, bet more heavily. I think that makes a lot of sense. But the actual maths behind Kelly are kind of flawed when it comes to investing, because the Kelly criterion basically assumes that you can make the same bet over and over again with known odds. And, that might work well if you're playing blackjack or flipping a coin or, whatever. Right. Flipping a coin's a bad example because you don't have an edge. But in something where you have a slight edge and you're able to make that bet over and over again, Kelly can work really well. But when you assess a company, you can make a judgment call on the odds, but you can only make that bet once, and the odds aren't known for certain. You have to come up with that on your own accord. So Kelly is overly aggressive for investing.
It's kind of like my favorite economist joke, where you're assuming all these factors and trying to. You're assuming things that aren't actually real, like coming in with all these different. Yeah, I know the probability of this is going to happen, and I can keep doing this over and over. That's not how the real world works. So, one thing one of my economics professors told this story about a physicist, an engineer, and an economist were all stranded on an island, and they had a can of food that they were trying to open. So the engineer suggested, hey, why don't we take some of the rocks and maybe we can kind of create this lever system to pry it open. That might work. The physicist was like, oh, no. Maybe we can somehow use this reflective rock over here to like bend the light at it, and that'll sort of melt open the can. And they turn to the economist and he says, well, guys, why don't we just assume there's a can opener? That's my favorite economist joke. I was an econ major, so thank you.
I love that you have more than one economist joke. That's what I'm happy about right now.
Yes.
This could be a new weekly segment. Jack's
That's all I got.
Jack's economist joke of the week.
I'll have to try. I could just keep telling that one over and over. I've told that one a number of times.
That's very good.
We'll see.
Can I get some thumbs up in the chat, guys? Did you like that one? Thank you.
Sure, I'll give you one.
Fantastic. Thank you, Brad. Let's try to get maybe one more question in here, one or two. Let's get one from Frank here. I've been researching mineral rights company over the past couple of days. Cash flow relying on the price of natural gas, so commodity company essentially. Would you consider a bet on an undervalued commodity business with limited downside? Well, I definitely would, since I have such I have a significant portion in commodities, like I was saying before. Though a lot of my commodity positions actually are quite diversified. I own like the GDX and the GDXJ, which is like an index of gold miners, for example. I don't do a lot of company analysis into those commodity positions. Most of it is the commodity itself, or just the general basket of miners. And again, that's a shorter to intermediate term position in lieu of all this inflation we got coming down the pipeline and what we've already had.
Yeah, I guess the inherent risk with commodity companies is they have no control, obviously, over what they can sell their products for, and depends on the business, but many of them often have limited control on their expenses also. So that's the risk. There's basically only two situations where I'd buy a commodity company. The first one would be, I've told this story 100 times, so I won't tell it again, but Monish Prabhai's IPSCO investment, where he had basically guaranteed cash flows because they'd sold their product for the next few years, and that was going to basically cover the price or the market cap at the time in a couple of years. So that's a situation where I'd be interested in it because it's putting basically a floor on downside. So that was Prabhai's original thesis going into GraphTech a couple of years ago, for example. And the other example is if you were able to buy something that's clearly that's clearly the low-cost producer of that particular commodity, and the fact that it's the low-cost producer is likely to change over time. So I'm blanking a bit on the name, but there's CF Industries. So that's a company that will show up in Phil Town's portfolio, for example. They have very low-cost access to natural gas in order to produce nitrogen fertilizer, and that's a competitive advantage that isn't going anywhere. So that's another situation where I'd be interested in the company. Valuing it can get kind of difficult. Like, you can attempt to try and normalize what the earnings are going to be and try and value it that way. Or hopefully things can get crazy from time to time and commodity prices tank, and you can buy things where they don't have to earn even anywhere near their normalized profits for the investment to make sense. So those are some thoughts.
And natural gas is an interesting space, at least for now.
Yeah, I haven't looked at it much. What makes it interesting, Karan?
It's just interesting. That's it.
It's just interesting. Okay, just putting that out there.
Yeah.
Fair enough.
I am invested in a company that is focused on natural gas, and I think it's very undervalued, but yeah, that's pretty much it.
Cool. I'm glad to hear that feedback from Nicholas Thompson in the chat as well. Karan, you're sounding good with the mic upgrades.
Yeah, so we had some sound issues.
Not just good. Karan, you sound amazing.
Oh,
I concur there.
Soothing.
Trying to wrap up on our last question here. There's a couple people want After Dinner Investor to come on to the show. We might have to do that soon.
Can I let out a sneak peek?
Go for it.
I'm actually talking to Mr. After Dinner Investor tomorrow. We're recording a podcast, so
oh yay!
if anyone wants to keep an eye for that, there you go.
nice.
Making moves.
Actually, if you've got questions, throw them in the chat, and I will pass them on to the After Dinner Investor if you like.
Mostly food-related questions.
Yes. Dinner and dessert questions only.
I guess we can close it on his questions then. When cloning, what role does their allocation play in your allocation? So do you try to mimic a great investor's allocation into something, or maybe try to mimic their conviction, if that's even possible, given some of the limitations with 13Fs, for example? You don't necessarily see smaller positions or certain foreign positions, so it's hard to say exactly what the allocation is. But with what we do know, does that play a big role? Brad, I think this is a good one to start with you.
Yeah, sure. Well, I usually only pay attention if it's like a top 5 holding, or say at least 10% of the 13F portfolio. But no, I kind of have my own method for coming up with allocation. So it would be separate from, the particular allocation of the investor that I'm cloning.
I tend to agree with that.
Yeah, I think it comes to the fact that, the ideas are transferable, but the conviction is not. So
True.
the conviction is going to vary, of course.
Even with the same ideas. Yeah, you're right. Well, I think that's a good one to end it on. Thank you, everyone, for stopping by. And we will be here same time next week, wherever that is for you in the world. But otherwise, another gentle reminder to smash the like button, smash the subscribe button, get on board so that you don't miss next week's or any other weeks after that. Since we want to keep everyone in, we love having this lively chat where we can pull great questions from you guys. It keeps it very interesting for us, and also often creates new content for our own respective channels as well. Which, by the way, if you haven't subscribed to those either, we always include the links to our respective channels in the description below. So go subscribe there if you haven't already. Too, I know I'm asking you guys to hit a lot of subscribe buttons, but that's what we got to do. We got to pump those subscribe buttons.
We've got to give people their homework.
Yeah, exactly. Come on, you guys got to do. We're value oriented here. This is the value we're asking for. We hope you enjoyed the content. Otherwise, but until next time, everyone, smash those buttons. See you guys.
See you.